Today, we're diving into the 2025 Invesco Capital Market Assumptions Report. This publication tackles a major challenge: how to approach U.S. equities in a multi-asset portfolio.
It's a timely topic, especially with U.S. equities reaching new highs. The S&P 500 even crossed 6,000 around the 2024 U.S. election.
A remarkable milestone. But the report suggests a looming concern. U.S. large-cap equity expected returns are now below 5% nominally and under 3% in real terms.
That's the lowest since 2004, and it's a global issue, not just a U.S. one. The report offers some diversification strategies.
Let's explore those. The report highlights several key themes impacting U.S. equity markets. Could you elaborate on those?
Certainly. Elevated concentration levels, high equity valuations, and the potential for a soft landing are all factors. The U.S. market capitalization makes up a significant portion of the global equity market, exposing investors to potential risks.
And the report emphasizes that this isn't just a concern for U.S. investors.
Exactly. Given the U.S. market's substantial weight in global indices, even passive global investors have significant exposure to these risks.
So, what are some of the diversification strategies the report suggests?
One key area is fixed income. The report suggests that fixed income now looks more attractive than equities based on a simple valuation measure like the Fed model. With yields above 4%, government bonds offer a compelling alternative, potentially outpacing inflation and providing portfolio diversification.
That's a significant shift. The report also mentions the potential benefits of fixed income during a recession.
Absolutely. Even if a recession doesn't materialize, which is the report's base case, risky credit assets like high-yield bonds and broadly syndicated loans offer attractive income potential.
Beyond fixed income, what other equity diversification options does the report explore?
The report suggests looking at global equities outside the U.S. These markets offer higher expected dividend yields and lower valuations, despite being slightly overvalued themselves. Emerging markets, in particular, stand out due to strong expected earnings growth.
Interesting. And within the U.S.?
Small-cap equities appear more attractive than large caps due to higher expected earnings growth and valuations closer to fair value.
The report also touches on alternative investments. What's the perspective there?
Alternatives like global REITs, infrastructure, hedge funds, and commodities are all positioned as potentially outperforming U.S. equities. Listed real assets, in particular, are still recovering from rising interest rates and offer attractive valuations and dividend yields.
So a broader diversification across asset classes is recommended. Let's delve into the specific 4Q24 CMA observations. What are the key takeaways for equities?
Global equity CMA returns are slightly higher than U.S. equities, primarily due to the overweighting of overvalued U.S. large-cap equities in the index. Most equity CMAs declined due to higher valuations, with the exception of Japan.
Japan bucked the trend?
Yes, Japan's fundamentals, as measured by the price-to-book ratio, have returned to their long-term average. China's valuation change is also notable, declining significantly despite a rising index price.
And what about fixed income in 4Q24?
Fixed income CMA returns also decreased, with current yields falling below expected future yields. Global aggregate bonds are expected to return less than anticipated. However, credit assets are still projected to outperform government bonds.
The report discusses how CMA's scoring aligns with tactical asset allocation positioning. Could you explain that?
The CMA scoring aligns with a contraction regime, favoring below-average risk levels and a preference for fixed income over equities. This makes sense given the higher relative expected return of fixed income.
So a cautious approach is recommended. Are there any divergences between the tactical and strategic views?
Yes. One key difference emerges when comparing U.S. equities to developed markets outside the U.S. Despite high valuations, U.S. equities benefit from a concentration of defensive companies that tend to perform well during contractions. This logic extends to developed versus emerging markets and large-cap versus small-cap equities.
The report highlights the role of long-duration government bonds.
Yes, they offer significant risk mitigation in a contraction due to their defensive characteristics and inverse correlation with equities as interest rates fall.
So to summarize, the report paints a cautious picture for U.S. equities, advocating for diversification across fixed income, global equities, and alternative investments.
Precisely. It emphasizes a strategic approach to portfolio construction, considering both long-term CMAs and shorter-term tactical considerations.
That was a great discussion.